Hello everyone. Today we are talking about the STR loophole, short-term rental loophole. And I want to be very clear right up front. This is not a hack. It's not a gray area. It's not something you do casually after watching a 30-second reel. This is a very real section of the tax code that, when used correctly, allows certain short-term rental owners to treat their rental activity as an active business instead of default passive investment treatment. And that single distinction is what makes this strategy so powerful. Here is the core issue that most high-earning business owners and professionals run into. You make great money, whether that's from your business or a W-2 or both. You invest in real estate, you hear it's tax efficient, and then you find out that losses don't actually help you right now. They just sit there. It's that because long-term rentals usually considered passive by default, and passive losses generally cannot offset active income. Luckily, short-term rule can bypass this rule entirely. If a property qualifies as a short-term rental under IRS rules, it's no longer automatically treated as a passive activity. Instead, it can be treated like an operating business, and that means losses from that property can potentially offset your W-2 income or your other business income. That's the entire strategy in one sentence. Now, let's talk about what actually makes a short-term rental qualify, because this is where details matter. The first requirement is the average guest stay. If the average stay is 7 days or less, the IRS generally does not consider the property a rental activity at all. It's treated more like a hotel or operating a business. That classification is what opens the door to active treatment. Once that door is open, the next requirement is material participation. This is non-negotiable. You don't get active losses just because you own the property. Material participation means you are meaningfully involved in running the short-term rental. And the IRS gives several tests, but the most common ones we see in real life are the following. You participate more than 100 hours during the year, and no one else participates more than you do. Or another rule, you participate more than 500 hours during the year, in which case it doesn't require that no one else participates more than you. So if there is no one else who participates more than you, then only 100 hours is enough. But if you cannot overcome that rule, then you need to participate 500 hours to qualify for this active short-term rental losses treatment to offset your other income. This is where people either qualify cleanly or fail completely. If you hire a full-service property manager and you are not involved at all, this usually doesn't work. If you actively manage pricing, messaging, turnovers, systems, decision-making, it often does qualify you, even if you have a property manager. So having a property manager does not disqualify you automatically. If you're still involved in making decisions and satisfy the hours requirements I mentioned above, you're still good and you will still satisfy the short-term rental requirement. And next one is documentation matters. This is not a trust me situation. Tracking, role clarity, intention all matter here. Now let's talk about why this creates such large tax savings, because this is part everyone hears about but not always understand. Once the activity is treated as active, you can use depreciation to create losses on paper without losing cash in real life. Through cost segregation and bonus depreciation, a large portion of the property's value can be depreciated much faster than the normal 27.5-year schedule. Then that often creates a very large first-year loss. It can be in the second year or in the third year. Depends when you do this cost segregation study. So it doesn't have to be in your first year. And it actually makes sense to analyze which year you have the biggest income besides rental, like your W-2, your other business income. And that's when it makes sense to do cost segregation study to offset that higher income. So you need to be intentional with this planning. So basically this depreciation creates a very large loss, and because the activity is active, if you satisfy the rules we discussed a few minutes ago, that loss can offset your other active income. So yes, someone earning a high income could potentially use a short-term rental to significantly reduce their tax bill in 1 year. We're talking about thousands, $100,000. That part is real. But this is where planning matters. Depreciation is timing, not magic. There are future considerations like depreciation recapture, exit strategy, and whether this still makes sense based on how long you plan to hold the property. A good strategy looks at the full life cycle, not just the first year refund. This is also why this is not for everyone. If your income isn't high enough, the losses may not be useful. If your lifestyle doesn't allow for material participation, it might not qualify. If you're doing this purely for tax and hate running a short-term rentals, it's usually a bad idea. For that reason, I put together a short-term rental readiness worksheet for today's live. Even if you're watching this on replay, grab it. It walks you through the income side, the time commitment side, and the structural questions you should answer before even considering this strategy. Because the biggest mistakes we see from people buying first and asking tax questions later. Used correctly, short-term rental strategy can be one of the most powerful tools available to high-earning business owners or W-2 owners. Used incorrectly, it's an audit risk and a financial headache. Next week, I'm going to talk about common short-term rental mistakes and how the IRS actually looks at this during audits, because that part matters just as much as the savings. If this clarified things for you, share it with another business owner who keeps hearing about the short-term rules, short-term rental loophole, but hasn't been told how it actually works. Saving taxes is great. Saving taxes the right way is better. That's it for today. Have a great one. Make it a great one. And I'll see you in a week.